I am Eddie, and I sit within Manulife Investments Retail Distribution and Partnerships team that manage our business relationship between Manulife Investments and iFAST, including FSMOne relationship in Singapore. Before I start, I'd just like to take this opportunity to thank iFAST FSMOne for giving us the opportunity to be in front of you today to discuss our investment views and what are some of the strategies that you can consider in a rate cut environment. Also, just like to thank you for your time, for giving us that opportunity to share our views with you. I think before we start, it would be useful to introduce my firm to you. We are Manulife Investments. We are the asset management arm of Manulife Financial Corporation. We are the largest, or rather Manulife Financial Corporation, our parent company, is the largest insurer in Canada. And together, on behalf of them, our asset management arm, Manulife Investments, we actually manage $500 billion worth of assets on behalf of our clients. Manulife Financial Corporation has about 150 years history of financial stewardship across the world. So with that, I'm going to start the panel discussion proper. Please allow me to take my seat. Right, I think the first question I'll probably direct to Leanne. Leanne is our client portfolio manager of our very successful flagship multi-asset income strategy. I think before we start, we all know that bond volatility has been elevated. Fed rate cut expectations in terms of the magnitude and the timing of the rate cuts have been all over the place. So I think what will be useful for us to kickstart this conversation is really to ask Leanne from our multi-asset solutions team, what is her team's outlook for 2025 and also her team's expectations for Fed rate cuts. Leanne?
Thank you, everyone, for being here today. So the flagship fund that Eddie was mentioning is our global multi-asset diversified income strategy. So it's a mouthful, but we call it GMATI. And the way that this product is put together really aligns with our outlook for the year. So our macro team, which sits within our multi-asset solutions team, our base case is for 3 to 4 cuts this year. And the balance of risk is towards fewer cuts. And also critically, GDP growth is slowing down globally, and there's divergence under the hood, which means some regions are doing better than others, which means there are a lot of opportunities. And one of the critical pieces that come together within GMATI is that the portfolio is globally unconstrained, which means it can invest wherever the most attractive opportunities are, across asset classes, across sectors, across geographies, and it is a pure income solution, which means it has the singular objective of delivering high, consistent income day in, day out across market cycles, whether we are in a high interest rate environment or a zero rate environment. Now, the critical characteristics of GMATI are that it is higher income, so really that income plus. So it's not in the lower bracket, 3, 4, 5%, but rather that higher 7, 8+%. And we've been able to successfully deliver that since inception more than 5 years ago. And the portfolio does this with a lower volatility profile compared to some of the high income paying peers out there in the market. So some of the higher income paying peers, they rely more on growth. They rely more on technology. Whereas for GMATI, we rely on the income generating properties of the holdings within the portfolio itself, which means that we are not reliant on consistent market conditions in order to consistently deliver that income to you. And of course, the last piece I want to highlight is that we do have options writing, both on the call and the put side, but they are covered and collateralized, which essentially means they are a tool that we can use to lower overall portfolio volatility and risk and to enhance income into the portfolio. And so the key characteristics of GMATI in an environment like this one, where we have rate cuts, is that it has consistently been able to deliver 7, 8+% income for investors since it was incepted. It has a lower volatility profile compared to a lot of its high-income peers, and it has that track record to demonstrate that it will be able to consistently deliver for your income needs. And so I think I've covered more on the fund rather than the outlook because you've already been given an outlook earlier today. And so, of course, if you have any questions about this particular strategy, our booth is right there. You're welcome to come ask us afterwards. So with that, I will pass the floor back to Eddie.
Yep, thank you so much, Leanne. On this slide, what is interesting for me is that we are unconstrained. We are globally unconstrained, but we are also unconstrained in terms of the quality of fixed income securities that we invest in. So we are unconstrained in terms of issuers, of course, geography as well, but we are also taking advantage of finding opportunities along the capital structure. So my understanding of preferred securities, it is a broadly investment-grade asset class that pays an income that's very similar to high yield, but of course of a better credit quality. And Manulife Investments, we do have a fund, Manulife Global Funds, Preferred Securities Income Fund, that currently distributes a yield on a monthly basis that gives a yield of north of 7% on an annual basis. Now, I understand that our multi-asset solutions team has a view on preferred securities, but I also have Dylan with me today. He is the expert in preferred securities. I also just want to ask, what exactly are preferred securities? Why are investors, including our multi-asset solutions team, having that favorable view on preferred securities?
Yeah, thank you, Eddie. Good afternoon, everyone. Thank you for your time this afternoon. So maybe just start off with a basic definition. When we talk about preferred securities, I'm sure you're very familiar already with credit, corporate bonds. Obviously, you're going to be familiar with equities. But what is really preferred securities? Preferred securities is really a third category that I would consider to be more like a hybrid category. It does have bond-like features, and at the same time, it does have equity features. So the chart on the left-hand side, you can see that preferred securities really sit in between your traditional bonds and common stocks in the capital structure. So what that means is if we get a situation where a company unfortunately goes bankrupt and they need to pay back the investors, first of all, they'll pay back the traditional bond investors first, and then they'll pay back the preferred security holders. And then lastly, if they have money left over, only then will they pay the equity holder. So preferred securities is really an asset class where you fall lower in the capital structure, but at the same time, the companies are aware of this and they're willing to compensate investors with a higher yield. That's why when Eddie was talking about a 7% plus income for our preferred security strategy, the reason why we can get this is because preferred securities is lower in the capital structure. And that's why the yield is there. But having said that, when we consider the companies that issue preferreds, they're really the well-known investment-grade companies. So in financials, for example, it's really the large banks like Bank of America, Citibank. In Asia, it's probably like DBS you're more familiar with, OCBC, HSBC. All these companies are large issuers of preferred securities. And then in the utility sector, for example, companies such as NextEra, which is a leader in power generation, I'll talk a bit more about that later, they're also big issuers of preferred securities. Now, the chart on the right-hand side, you can see that the value proposition for preferreds is really highlighted here. The yield obviously is very eye-catching, 7.1%. But if you notice the three letters at the bottom, BBB minus, that actually shows what the average credit rating for preferreds is. So it's actually investment grade rated, and it's a very high quality. And when we compare the yield versus something like a US investment grade bonds or with US treasuries, for example, there's clearly a yield pickup in preferreds. And really the significant statistic is the chart at the bottom showing the default rate over the last 10 years when we talk about global high yield, a typical default rate is around 3%. But for preferred securities, it's actually 0.08%, so very, very low.
Yep. Thank you so much, Dylan. So staying on preferred securities, in my free time, I also like to look at the FSMOne website and get investment views from FSMOne as well. And now and then, we do read reports on their views on certain subordinated debt. Some of them are more issued by the local banks like OCBC, for example. So I believe that a lot of investors in Singapore probably already have their single line exposure to subordinated debt because these are all high quality issuers, robust balance sheet, highly regulated by the MAS, which has very high standards. So I just also want to ask, for our Manulife Preferred Securities Income strategy, besides financials, are there any other sectors that we invest in a big way in? And why do investors need exposure to these sectors in addition to the financial sector?
Yeah, sure, Eddie. So we can just skip to the next slide. Basically, you'll see that the chart on the right-hand side For preferred securities, you can see the blue really shows banking, 38.2%. Insurance in the pink make up 20.7%. So if we add other financials as well, in total, the financial sector makes up around 70% of the market. The left-hand side chart shows how we approach it for Manulife. So we tend to take a bit more diversified approach. In particular, we tend to be overweight the utility sector, but underweight financials. And let me just give you one example. I believe the previous speaker was mentioning about the AI boom that's happening at the moment. That's actually something that's very exciting for us. Even though we invest in preferreds, we invest in more defensive companies like utility companies, the AI boom is really going to help generate demand for data centers and also demand for electricity. And I think one of the beneficiaries for this trend will actually be the large electric companies in the US that need to build capacity, and they'll be coming to the market looking to investors like ourselves to really invest in some of their bonds, and they'll be happy to pay a decent yield and return for us.
Yep. Thank you so much. I've heard about this as well. So one of our colleagues, Joe, he did mention to me that a ChatGPT search consumes 10 times more electricity than a Google search. So as we adopt generative AI in our everyday lives, we probably will consume more energy, and I will not be surprised that our utilities bill going forward is going to be slightly higher, especially if we adopt EVs. So I'm sure utility sector will be a very strong beneficiary of this trend. So maybe staying on preferred, when I look at the unit trust landscape in Singapore, it does appear to me that not many asset management companies manage a preferred securities income strategy for retail investors. So why do our clients choose us? What is Manulife's edge in preferred securities?
Yeah, that's a great question, Eddie. So we've actually been managing preferred securities for well over 20 years. So we're also one of the largest investors that specialize in this space in the US. So what that means is that, when companies like, Next Era that I mentioned, when they come to do a deal, we're probably one of the first names that they look for in Boston when they're passing through. So it definitely gives us good access to new deals, and we know that we can usually get a good allocation that we want. But yeah, probably the other point I would highlight is the expertise of our team. So you mentioned Joseph Bazoin, our portfolio manager. He's been a career analyst, first of all, as a credit analyst. He spent some time as an equity analyst. And then even now, when he's the portfolio manager, he really has a deep understanding of the utility sector. So I think, that really gives us a lot of depth in that space.
Great. Thank you so much. So today's topic is actually talking about investment opportunities in a Fed cut environment, right? A rate cut environment. And when we talk about declining interest rates and rate cut, most people like to think about investing in fixed income. But there are also ideas in the equity space that can potentially benefit when we are entering a declining rate environment. So with that, I just want to look at the equity space. What are some of the opportunities that we are seeing? So my next question is for Derrick. He's our portfolio manager for from our equities team, specializing in Asia-Pacific REITs. So, Derrick, we know that there's a lot of volatility in AP REIT, Asia-Pacific REIT, but we have also all read that by and large, financial institutions across the Asia-Pacific region has expressed a very positive view on REITs. So, help us make sense of this. Why are people positive, but then there's also elevated volatility?
Sure, Eddie. Maybe let me just start off with talking about the recent volatility before talking about why we are actually constructive on AP REITs in the year ahead. If you look at the chart in front of you, effectively you see that we have gone through a very sharp rate cycle. So by and large, this has kept AP REITs under pressure since 2022. But if you look at the middle of 2024, we actually seen the sector bottom out. And in third quarter, we staged a very powerful relief rally on the back of the first interest rate cut, as well as expectations for improving interest rates cuts in the year ahead. So at that time, we were expecting around 10 rate cuts into 2025, but I think nowadays the interest rate environment has actually been shifting a little bit higher. So if you look at the Trump presidential win, effectively the policies are expected to be a bit more inflationary in nature. So now we are expecting a shallower rate cut ahead. So this led to a bit of a retracement in the AP REIT sector. But we think that at this point in time, the valuations are attractive, sector expectations are low, so it's actually a good time for somebody to look at this sector itself for an exposure to AP REIT. Three things I want to highlight to you when talking about the outlook for the sector. First is that the dividend erosion from higher interest costs is coming to an end. Our proprietary analysis of various fixed income and derivative instruments showed that increasing number of REITs with marginal cost of debt trading below that of their latest debt on the books. So what that means is that interest costs will be lower, so that is supportive of distributions. Secondly, real estate fundamentals for many subsectors are actually still holding up well. So what that means is that we have resilient occupancy and rent growth. So this means that property income will continue to hold up well broadly for the sector, and this is supportive of distribution. Lastly, if you look at the stabilization in interest rates, we have seen a pickup in the activity levels. So we expect more and more yield accretive acquisitions to come through, which can add another layer of DPU growth for the sector ahead. So this is a good time for somebody to gain exposure to the sector in our view.
Yeah, thank you so much, Derrick. Of course, we are also seeing a lot of opportunities outside of Singapore. We know that Singaporean investors are huge investors of Sing REIT. In our Manulife Asia Pacific REIT Fund, we do also seek opportunities on behalf of our clients in markets like Australia, Hong Kong, and even countries like Thailand. So we only have one question. We only have time for one last question, and I think we want to stay in Asia. We have a very successful Asia Pacific Investment Grade Bond Fund. The Manulife Asia Pacific Investment Grade Bond Fund is actually one of the recommended funds in its asset class category that is recommended by FSMOne. So with that, I think since we are entering potentially a new interest rate regime, Dylan, can you share with us our team's view on Asia fixed income across the different space, IG, higher?
Yeah, thank you. So I think Asian bonds was really underappreciated the last 2 years. Obviously, we had a lot of volatility, with the Fed hiking rates and also the credit situation in China. But I think 2024 was really a strong year, and I think we are starting to see Asian bonds come back in a big way. Investment grade bonds, for example, returned around 5.5%, outperforming US investment grade. Asian high yield returned an impressive 14%, probably the best performing fixed income asset class. So I think this year, 2025, we're still optimistic. You can see for the chart on the right-hand side, the green line, Asian high yield is still yielding about 10%. So there's really a lot of opportunity, and our team favors that. But on the investment grade side, I think it's also quite attractive risk-adjusted returns. So I think depending on your risk tolerance, both IG and high yield for Asia looks good this year.
Great, thank you so much, Dylan. With that, I probably will call it a wrap. I hope over the past 10 minutes or 20 minutes or so, we have introduced Manulife Investments' range of income options to you. Going into a rate cut environment, a declining rate environment, it's important that we look at opportunities in terms of income solutions. So we do have that wide range of income solutions for you. If you would like to find out more, please feel free to visit us at our booth just behind you. With that, thank you so much for your time. Thanks a lot for your kind attention. Thank you.